Welcome to the third video in our climate investing series for fund managers. So far, we've explored what climate investing is and why it represents such a compelling opportunity. Now it's time to shift gears and focus on the how. How can you, as an investor, approach climate investing strategically and effectively? Whether you're a seasoned investor looking to integrate climate considerations into your process or entirely new to the field, this video will provide you with a practical framework for success. We'll walk you through the key steps of developing a climate investment strategy, integrating climate considerations into your processes, and ensuring measurable impact. By the end of this video, you'll have a clear path to get started or to refine your approach. Let's dive in. Before we begin, let's lay some groundwork by defining a few important terms. A climate investment strategy is a structured plan that outlines how climate-related considerations will be integrated into your overall investment approach. It serves as a guiding framework for decisions about which sectors, geographies, and types of solutions to prioritize. Due diligence is another essential concept. This is the process of thoroughly investigating a potential investment opportunity to confirm all relevant facts, including financial data, operational details, and in the context of climate investing, climate-related risks and opportunities. We also have impact assessment, which involves evaluating the potential positive and negative effects of an investment on climate change. This could include examining how much a project reduces emissions, how many people it protects from climate risks, or other measurable outcomes. Lastly, let's touch on climate finance. This refers to capital that is allocated specifically to address climate change through either mitigation, reducing or avoiding emissions, or adaptation, which focuses on helping communities and businesses cope with the impacts of a changing climate. A climate investment is an investment in a company or project that provides technologies, products, or services to address the causes or consequences of climate change. For example, renewable power generation avoids emissions by replacing fossil fuels. Energy-efficient products reduce emissions by consuming less energy, and reforestation projects remove carbon dioxide from the atmosphere by storing it in trees.
Approaching climate investing strategically involves several critical steps. Let's break them down one by one. The first step is to develop a climate investment strategy. Start by defining your objectives. Are you focused on mitigation, investing in solutions that reduce or avoid greenhouse gas emissions? Or are you more interested in adaptation and resilience, which help communities and industries prepare and respond to climate impacts? Perhaps your strategy involves a combination of both. Once your objectives are clear, identify the sectors and geographies that align with your expertise and goals. For example, if you're knowledgeable about renewable energy, you might target investments in solar or wind projects in emerging markets. If agriculture is your area of focus, you could explore opportunities in climate-smart farming practices, such as water-efficient irrigation or agroforestry systems. It's also essential to set clear criteria for what qualifies as a climate investment in your portfolio. For instance, you might define these criteria based on the MDB's and the IDFC common principles for climate mitigation and adaptation, or a local taxonomy, or prioritize projects that align with the Paris Agreement goals. Clear criteria help ensure your investments have tangible climate impact and meet high standards. The next step is to integrate climate considerations into deal sourcing. Building relationships with climate-focused accelerators, incubators, and networks can provide you with early access to innovative opportunities. These groups often work closely with startups and emerging technologies that align with your climate objectives. Staying informed about emerging solutions is also vital. Attend climate tech conferences and events to understand the latest developments in areas like renewable energy storage, carbon capture, or advanced climate modeling. Training your team to recognize climate-related opportunities within your focus sectors will further enhance your ability to identify promising investments. Once you've identified a potential investment, the next step is to incorporate climate assessment into your due diligence process. This involves evaluating the climate impact potential of a company's core products or services. Ask questions like, does the solution directly reduce emissions? Does it enhance resilience to climate impacts? It's equally important to assess the company's own climate-related risks and opportunities. For example, are they vulnerable to supply chain disruptions caused by extreme weather? Or are they positioned to capitalize on policy incentives, such as tax credits for renewable energy? It may be beneficial to engage climate experts to perform technical evaluations and ensure your analysis is thorough. From there, you'll need to develop a framework for measuring climate impact. Start by defining key performance indicators, or KPIs, for your investments. For mitigation-focused projects, this might include metrics like emissions avoided or renewable energy generated. For adaptation projects, you could track the number of people better protected against climate impacts, or the economic losses avoided through improved infrastructure. Baseline measurements are crucial. Establish a starting point for these metrics and set clear targets for improvement over time. Finally, plan for regular monitoring and reporting. This ensures transparency and helps you and your stakeholders understand whether the investment is achieving its intended impact. Supporting your portfolio companies is another key component of climate investing. Help them maintain their climate impact objectives and connect them with resources or expertise they may need to succeed. For instance, if a company you've invested in is developing renewable energy solutions, you might link them with experts in grid infrastructure or energy storage to help scale their impact. Encouraging regular reporting on climate-related metrics not only drives accountability, but also helps your companies continually improve their performance. Finally, consider climate factors in your exit planning. Highlighting the climate impact and performance of an investment in exit materials can make it more attractive to potential buyers, particularly those who value sustainability. At the same time, think about how you can ensure that the climate impact of the investment continues post-exit. For example, you might target buyers who are committed to scaling or sustaining the climate solution. Remember, climate investing isn't just about avoiding harm. It's about actively seeking out and supporting solutions that address climate challenges head-on for the long term.
So how do you begin implementing this approach? Start by reviewing your current investment strategy. Identify areas where climate investments can be integrated. Next, develop a set of climate investment criteria tailored to your focus areas. These criteria will guide your decision-making and ensure your investments align with your objectives. Training your team is also crucial. Equip them with the knowledge and tools to recognize climate-related risks and opportunities. This might include workshops on climate finance frameworks or guidance on evaluating emerging technologies. Building relationships is another key step. Start connecting with climate tech experts, accelerators, and networks to expand your access to opportunities and insights. Finally, consider piloting a climate investment strategy. This will give you hands-on experience with the process and help you refine your approach moving forward. Let's summarize what we've just covered. Approaching climate investing strategically involves several interconnected steps. First, you need a clear climate investment strategy. This means defining your objectives, whether they focus on mitigation, adaptation, or both, and identifying the sectors and geographies where you can have the greatest impact. Second, integrating climate considerations into every stage of your investment process is essential. From deal sourcing and due diligence to exit planning, Each step offers opportunities to maximize impact. Third, measuring and monitoring climate impact is critical. By defining KPIs, setting targets, and regularly reporting on progress, you can ensure your investments are not only profitable, but also meaningful in addressing climate challenges. Finally, climate investing is about collaboration, supporting your portfolio companies, engaging with climate experts, and building strong networks will help you identify and scale impactful solutions. By following these steps, you can align your investment strategy with one of the most urgent issues of our time while capturing opportunities in a rapidly growing market. Now it's time to take action. Start incorporating these steps into your investment process today, and don't miss our next video, where we'll explore the exciting opportunities in climate adaptation and resilience investing. Thank you for watching, and remember, a strategic approach to climate investing not only delivers financial returns, but also helps drive the solutions our world urgently needs.